Ladies and gentlemen, it takes courage to predict the future publicly and on the record, as our speakers are about to do. It takes even more courage to take big risks on the accuracy of those predictions. I assume our speakers are doing that too. But it takes a lot more than courage to predict the future accurately. That takes intelligence, hard work, and an ability to see patterns in huge amounts of raw data. That's what great investors do and great fortune tellers do. And it's what our speakers today have been doing for years. Thomas Caldwell is an industry legend, as you know. He's been actively involved in the investment industry since he graduated from McGill in 1965. He's the chairman of Caldwell Securities, the CEO and a director of Urbana Corporation, and chairman of the Canadian Securities Exchange. He is a past governor of the Toronto Stock Exchange and is recognized as one of the world's foremost investors in securities exchanges. He also serves on the board of the Conference of Defence Associations Institute in Ottawa, is an honorary lieutenant colonel of the Lincoln and Welland Regiment, and was recently inducted into the IIAC Investment Industry Hall of Fame. It's a bit intimidating. Ian Russell is President and CEO of the Investment Industry Association of Canada, a position he's held since its inauguration in April 2006. Prior to his appointment at the IIAC, Ian headed the Industry Relations and Representation Group of the Investment Dealers Association of Canada. Ian was recently appointed chair of the International Council of Securities Associations. He's the first Canadian in 20 years to serve in this capacity. He's a frequent columnist in industry publications. And last but not least, Avery Shenfeld is Managing Director and Chief Economist of CIBC World Markets. He's been with CIBC since 1993 and is widely recognized as one of Canada's leading economists. He's a four-time winner of the Dow Jones Market Watch Forecasting Award and has received awards for forecast accuracy on the U.S. and Canadian economies from Bloomberg Markets. He has also been consistently ranked as one of the top Canadian economists by institutional investors. We are very privileged to have these very distinguished speakers with us today to offer their views on what 2015 is likely to bring to the investment community. Our format today will be a little bit different than our usual format. Instead of appearing as a panel, our speakers will come to speak to you one by one. Let me start then by inviting Thomas Caldwell to join me at the podium. Mr. Caldwell.
Thank you very much. I kind of like that legend talk.
Thank you. I thought you would.
It's hard to get through all this in the 90 minutes that have been allocated me, but I'll do my best. I wanted to follow up on my last talk, the last time I was here, regarding regulatory strangulation, because that's a trend that I've been on. I'll just briefly cut it, and then I'll get into the real stuff. I don't know if you were here then, but I brought in the Ontario Securities Act of now and the Ontario Securities Act about 20, and difference in size. I can't do that anymore because the regulators have moved to tissue paper. So I have had an impact on government. My prediction was the decline of the independent investment advisors. My prediction was exceeded. I used the number 20 firms would leave the field. Since that talk, 32 independent investment advisors have closed shop. Regulations continue to explode in volume and implode in relevance. Investment advice and advisors are still being hammered by regulators, their lobby groups, the media, ignoring all client satisfaction surveys. It's hard to imagine similar behavior by the Law Society. You know, can you imagine the Law Society coming out, 50% of all lawsuits are lost by somebody. Therefore, lawyers are no good. Or can you imagine that you talk about the trailer fees? Can you imagine the Law Society saying, we don't believe we should allow retainers anymore for lawyers? Can't see that. Or the Canadian Medical Association, people still dying, doctors useless. Whatever. So I give some advice to regulators. Quantity is no substitute for quality. That's not taught in law schools. The opposite is taught in law schools. And part of it is too much information is no information. Anybody here ever read a prospectus? No, you haven't. I know you haven't. How many of us have signed them? Example. Sadly, the trend of investors losing independent advice will continue through this year. Let's get the real stuff, the forecast stuff. The key part of my job when not coping with regulatory demands is to discern what is important within massive information overload. That means I have to filter and simplify and to come down to decisionable actions. 2014 had lots of geopolitical distractions, although tragic and distressing at the human level. Most, to quote that great investment advisor Hyman Roth from The Godfather, had nothing to do with business. And just keep that in mind. Now, despite the rhetoric and overanalysis, only a few factors were and are relevant to capital markets, in my opinion. First filter that I use relates to the raw material I use for decision making. For example, I am very cynical about any government statistics, whether GDP growth, inflation, unemployment, quit rates, all of these. They're late, inaccurate, and they're open to manipulation. The only numbers that count are corporate earnings. They are the only ones you go to jail for manipulating. They showed corporations and the economy were all growing last year. Admittedly, in some cases at a glacial rate, but they were still growing. Second point, deflation. Lots of talk about deflation. Concerns about deflation, long-term deflation that is, in North America, are a scam. Yes, there will be downdrafts in the economy and sectors, but anybody who bet on long-term deflation over my 50-year career has lost money. The third thing is what I consider to be the determining factor for markets and economies, and that is interest rates. Interest rates are the price of ownership of everything. And the current level of interest rates subsidizes ownership. It subsidizes your buying a house, buying a car, buying stocks, whatever. Go out and borrow money and buy stuff, basically, despite all the deflation talk. Yes, interest rates will go up, but when they go up is irrelevant. When rates are raised, it will be underpinned by a strong economy. And any increase in interest rates is going to be gradual, and it will be late. It'll be long after this economy is rolling. No central banker on earth is going to risk cutting off a nascent economic recovery. They will not be precipitous in this. They will want to be sure, and that'll make them late and gradual. Low rates will continue to provide steam under the economy through 2015. The Yellen bounce, they're going to do it at the end of it, shouldn't have been a surprise to anyone. Oil prices. Oil prices are a combination of geopolitical, the U.S. and Saudis trying to put pressure on Russia and Syria and Iran, and then the Saudis trying to put pressure on America, and everybody trying to put pressure on everybody, and simple supply growth, that is shale and enhanced drilling. And self-sufficiency for the United States in oil will have tremendous connotations for Middle East policy, and indeed the XL, which is always in our newspapers. Overall, the current oil pricing is positive. When I wrote this paper, by the way, it's about $800 tax cut for every U.S. family. That's low now. It's low. It's more than that. And it's more if you add in the ripple effect of industrial production costs. This is a significant stimulus for the overall world economy. Now, clearly, lower oil prices aren't a positive for producing countries such as Canada. It impacts the dollar, our economy, anticipated government surpluses, but it does create bargains in Canada. Now remember, I'm a garbage man. I just look for stuff where there's crisis. That will create bargains across the spectrum wider than oil in Canada. If I had to give you my forecast sounds quite official. This is my guess. My guess is as bad as anybody else's, just so I qualify this. If I had to give you my forecast guess, I would say oil will probably range between 60 to 80 bucks, somewhere in there. Maybe even 70 to 90 at some point, but 60 to 80. And everybody more or less is all right around those levels. And I think what is happening is pricing for oil is moving more into normal range, whatever normal is. 110, 120, that's not normal pricing for oil. We got used to it, but it wasn't normal. I don't even know what normal is, by the way, but that is not normal. Back in the 60, 80s. So that's my best guess. Another positive from this current pricing event is the increasing odds that for the foreseeable future, the future of energy is going to really hurt you green people. It's going to be hydrocarbons, because alternatives will just require too much subsidies to make them work. So how do we work with these factors? Well, I'll just tell you about the funds that I'm responsible for and my partners at Caldwell Investment Management. We still hold large positions in major U.S. financials such as Citicorp, Bank of America, Morgan Stanley, Chicago Board Option Exchange. And it was a little bit like shorting oil. because we're out of the Canadian dollar, because the Canadian dollar moves in lockstep with oil. The U.S. banks are approximately half the price of their Canadian counterparts because they're still being brutalized by regulators with multi-billion-dollar fines for everything and anything. Eventually, we believe this will ease, and the major U.S. banks will be able to increase dividends and become more aggressive regarding share buybacks. In the interim, they're consolidating operations, building better companies, and keep in mind, whenever they sell a division or a subsidiary, you always get a lot more money than the price they're on the books for. There are always hidden wins as you shrink a company down. Our future thinking involves rolling some funds back into Canada on our reduced dollars. I recently purchased some Suncor and Canadian Natural Resources just as starter positions. They start to pay attention. We would also anticipate buying some of the major Canadian banks as the oil impact gets increasingly felt. So we'll be reducing our U.S. dollar ratings. For example, in the public pool that I'm most involved in, I'm about 80% U.S. dollar exposure. Now remember, when we roll back into Canada, unlike the U.S. bank, the Canadian banks are a protected and nurtured species in Canada, and they have some decent dividend yields. Regarding the raw material sector, we're of the opinion China will surprise on the upside. Not right away, so we're delaying positions in the metal stocks, etc., until we have greater clarity. Now keep in mind, China has no qualms about understating their economic performance in order to drive down the price of metals or their raw materials. The Japanese did this years ago. Remember when Japan was this, they would, oh my God, the economy's ending, and boom, down would go metal prices, and Sumitomo would scoop all the markets. So, I mean, they fight an integrated game. Now, the public pool I mentioned is a company called Urbana Corporation. It's listed in Toronto in the Canadian Securities Exchange. And you can go on the website, urbanacorp.com, and you can monitor, what we're doing in markets weekly. We sort of bring that up to date. So there's my company plug in there. But at any rate, you can see what we're doing real time and see how we monitor during the year. The final 3 points I'd like to mention are what I consider macro or longer term trends. This is not going to affect 15, but you got to plug them into the back of your brain. And one of them is, I have a place down in Naples, Florida. 50% of the CEOs of the Fortune 500 company have homes in Naples. I mean, it's incredible. I mean, $90 million shacks on the beach. It's off the Richter scale. And I don't have one of them, by the way. But it hit me, over the years. The one macro trend I would worry about is the massive disparity between the wealthy and everyone else in America. This underpins almost everything going on in the United States. Civil unrest, rules and regulations, Ferguson and the nonsense. You're having this, and the middle class isn't catching up. It's pulling apart. And this group has tremendous influence in government. They call Bill Gates or Buffett and what are going to do anything in that. But most people aren't living the American dream. And even the forced subprime financing of homes was based on this dichotomy, which they're trying to address. It'll always be a factor you can plug into the back of your brain. The second danger point to watch going forward are regulations of all varieties, not just securities regulations, but are exploding. And the dangerous side effect of this regulatory self-funding in the United States, not as much in Canada, is the plundering of the private sector in terms of insane fines and settlements against corporations. That is, shareholders have to pay these fines, the companies do, for management transgressions. Let me give you an example. J.P. Morgan, remember the London whale? That was that big futures position. They blew $6 billion on the whale positions. These are hedge positions. $6 billion loss. Who lost that money? Shareholders. And the SEC had a chance to look at that and they said, this is terrible. We're going to fine them $4 billion for losing $6 billion. Now, who did they fine? The shareholders. It's like, I don't, how they got away with that, I don't know. And Jamie Dimon still gets to fly it around in his Mood jets, in and out of Naples, by the way. What's going on? Am I missing something here? The shareholders pay the price. The London Economist describes this process, this is the U.S. regulatory environment, as the most lucrative shakedown operation in the world. It's a new taxation becoming a major brake on the economy. Remember, fiscal and monetary policies can be neutralized by regulatory or legal lockdown. The third danger point, and again, I'm standing out beyond 2015, is what I refer to as product complexity. And this will probably precipitate our next financial crisis. And yeah, we will have a next one. We have them every 10 years. It's an annual or 10-year theory we go through. And that's where we, the nice part about humility, if you don't seek it, stick around. It will be coming. And I mean, for example, remember those insured garbage bags filled with junk mortgages? You know, that and during the subprime banking crisis, product complexity. And I think that this will be the derivative sector, and possibly, and this is my best guess here, it'll be the ETF world. Now remember, today's flavor du jour usually becomes tomorrow's crisis. That's almost always the case. There's a terrific media campaign in support of these products and their variants. ETFs are also massive money spinners for their sponsors in structuring and maintaining the underlyings of the securities. Everybody says, oh, it's low fees. There's a lot of stuff that's buried in there. ETFs, by their total size, now significantly distort share pricing. So my best, and there's levered, and there's triple ups, triple downs, etc., as we get more and more complex. And I will say one thing on behalf of regulators. Somebody once described regulators to me as lumbering giants trying to catch up with sprinters, and they can never do it. So by definition, they have to be behind the curve, because it's always something new that's going to blow up. So if I had to say what's the next thing going to happen here that's will be really upsetting, it will be out of the complexity of products within the securities business. And this is typically the case. The British have this wonderful phrase, too clever by half. And I think in our industry, from time to time, we get too clever by half. Now, not to leave you with those three danger points as I look forward. On balance, and now remember, I'm an incurable optimist, and it's served me well. But I would just say to you, on balance, I think 2015 is going to be a very good year for equities. Not a very good, but a good year for equities. And that's my opinion. I'm sticking to it. Goodbye.
Thanks very much, Thomas. I'm sure you meant to include telcos as Canadian telcos as great places to be in 2015. Yes. Our next speaker is Ian Russell. Please join me on the podium.
Thank you, Andrea. It's a great pleasure to be here this year at this annual look ahead. And I'm also very pleased to be following Tom Caldwell. The IIAC had great pleasure of recently inducting him into the Investment Industry Hall of Fame, as you heard from his stellar resume. And this was a fitting tribute to a man who has dedicated his life to promoting excellence, integrity, and innovation. For the past 3 years, every November, we have polled CEOs of our 160 member firms on economic and financial business conditions for the year ahead. The results are used to demonstrate the challenges and the opportunities facing the investment dealers and their firms, and to support the case for an appropriate direction and balance for regulatory policy. Last year at this event, I described how the CEOs were tepidly optimistic about the industry's prospects for 2014. In looking ahead to 2015, we can remove the word tepidly. The survey, of course, was undertaken just before the swoon in oil prices and the related market decline. But as the latest market ups and downs remind us, the bad news of the past 3 months stands a good chance of being reversed. The survey offers a longer-term view. The results augur well for our capital markets in 2015, especially given the survey's track record. Over the past 2 years, the survey's cautious optimism about the economy has been borne out. In assessing our economic future, the investment industry is, I would describe, the canary in the coal mine. Market activity, financing and trading is a distillation of people's expectations of the economy, confidence in corporate earnings. In other words, the industry's health is a shorthand way of interpreting how people are thinking. Looking ahead to 2015, the canary is chirping merrily. Predictions for profitability are up significantly for the coming year. Perhaps the most positive result is this. 70% of executives who participated in this year's survey predicted that their firm's profitability would be up in 2015. That's much higher than the 48% who felt that way a year ago. If the results are borne out, that would mean two things above all. First, for the third year in a row, industry operating profit will increase. And two, the earnings will be well spread among large and small firms in the industry. Overall, though, the survey indicated that we continue to see change, driven not by one big revolutionary event, but the ongoing impact of three distinct trends, these being regulatory, demographic, and technological. Let's take regulatory change. When asked to identify their firm's top barrier to growth, 84% of CEOs in my industry named ongoing regulatory burdens. Sweeping regulatory reform has engulfed all investment dealers. Institutional and retail firms face client order protection rules in multiple equity markets, forcing them to contend with the costs of extensive new technology and the unintended consequences of spiraling market data costs. Retail firms also face serious regulatory challenges in terms of the comprehensive disclosure of the investing process, disclosure of conflicts of interest. Fees and advisor compensation and portfolio performance must also be disclosed. These embrace complex securities valuation and the detailed computation of portfolio data. These are complex matters. They require clear direction from the regulators before the technology can be developed and the systems then put in place. Of course, these reforms will benefit baby boomers. They are demanding a wider array of products and services and choice in discretionary management and financial and estate planning services. This leads me to the second trend facing firms, the impact of demographics. Aging baby boomers have shifted portfolio emphasis from transactional focus to discretionary managed portfolios, which are tilted to conservative asset allocation. As well, portfolios will place greater attention on income and asset distribution. Meanwhile, tech-savvy millennials are difficult to reach and more difficult to persuade to take financial advice. They are surprisingly risk-averse, having witnessed the tech crash in 2000, 2001, and the financial crash in 2008. The impact of these two groups can be seen in the survey results. More than 77% of CEOs said their top area of growth would be wealth management. This is especially important to baby boomers. About 72% of firms said they plan to hire more investment advisors. That's important for both boomers and millennials. Many of the millennials who will feel more comfortable dealing with younger advisors. The third trend in these results is recognition of the importance of technology. Let's see a show of hands. This holiday season, how many of you ordered gifts or made travel arrangements online? You're not alone. This year, Cyber Monday put Black Friday to shame. People demand the same cyber convenience of their financial advisors. But increased technology and systems and integrating the systems of our introducer firms and carrier firms adds significantly to fixed and variable costs. That puts particular pressure on small and mid-sized dealers. In fact, technology changes were cited as a barrier to growth by 37.5% of the CEOs surveyed. These three trends are placing enormous competitive pressures on the industry, especially our small and mid-sized investment firms. Overall, though, the survey's indication of improved business conditions is great news for the industry, for their clients, and for the Canadian economy. This is a healthy picture, and while we face challenges, investment industry CEOs see a confident investment marketplace. Thank you.
Thanks very much, Ian. That was great. Next up is Avery Shenfeld. Avery, please join me at the podium.
Thanks very much, Andrea. Usually when I'm asked to talk on the economy and financial markets, it's actually even a shorter than 10-minute period because I'm passing someone in the hallway, one of my colleagues, and they say, So what's the outlook look like? And they want that 1 second status report. And those of you, especially the young people over there, who are probably more familiar with this than some of us and the rest of us in the room, will know that on your Facebook page, you can have that 1 second status report. You can say that you're single. You can say that you're in a relationship. Or if you're in a relationship, but you're not quite sure, maybe you're open to something else, you can say, it's complicated. And that's actually the answer for the economy and to some extent financial markets. It's complicated because we find ourselves here in Canada betwixt two poles. Sort of we're next door to an economy in the U.S. that I think is very much in gear. We're looking for growth of over 3% next year. And the equity market has it right. The reason the S&P has been flirting with new highs and so on is that corporate America is in pretty good shape. And there's still a long road ahead. We are not near the end of a cycle. We're relatively early in a cycle that has a long way to run in the U.S. economy. And it does seem in gear. And yes, they have an oil industry that might slow a little bit in the near term, but it's still a small part of the economy. They have an export sector that doesn't have the most vibrant trading partners, but that too is not as big a deal in the U.S. And what they have ahead of them is still the whole recovery in consumer spending and home building that is really only just getting going. So it's a very vibrant market just to our south. And certainly that's an area where Canada can capitalize on, particularly those Canadian companies that export to the U.S., to that household and consumer sector, and now have the benefit of a cheaper Canadian dollar to be more competitive. But I said we're between two poles because across the ocean, things don't look as bright. The Eurozone has been flirting in and out of recession, might grow by 1 or 1.5% next year, but that's not spectacular. When we used to talk about the BRIC countries, Brazil, Russia, India, China, well, they've sort of landed like a brick, actually, because you've got Brazil in recession and Russia in recession. India looks a little bit brighter, but China is slowing in the areas that we like it to grow in. So it's becoming more of a consumer economy, a bit less of a capital spending economy, even if in the near term they're going to give some spark to that with some infrastructure spending. So Canada's caught in that middle road, and where does that leave our financial markets? Well, if we talk about central banks, it really is going to be the case that, to some extent, the U.S. is going to be an island unto itself for most of 2015. We are getting to the kind of unemployment rates in the U.S., in other words, low enough, where it no longer makes sense for the U.S. economy to have those ultra-low, zero overnight rates of interest. That doesn't mean that the Fed will be in a hurry to push interest rates back to anything that we used to think of as normal. But it does mean that by the end of the year, we're going to be looking at an overnight rate of 1 or 1.25% versus 0. And I think the surprise will be that the Fed moves a bit earlier than the market expects, but then actually pauses for longer than the market expects after taking rates up to 1%. They'll be doing that hiking pretty much alone. So certainly in Europe, Asia, we don't expect interest rate hikes out of the likes of Japan and the Eurozone. Here in Canada, I think the Bank of Canada seems committed to lag significantly behind the Fed in terms of raising interest rates. If oil manages to recover significantly before the end of the year, we might have a quarter-point hike out of the Bank of Canada before the year is done. But, hey, what's a quarter point between friends? I mean, it's not a significant move towards higher rates, in part because the Bank of Canada actually has an agenda, even though they deny it, to let the Canadian dollar weaken still a bit further in order to transition the economy from building condos to an economy that leans more on exports and starts to attract new plants in the manufacturing sector to lever up our export growth down the road. So short-term interest rates not really going anywhere specifically in Canada, going up about 1% in the U.S. What does that mean for bond market investors? Well, bond market investors, particularly in the U.S., are in a bit of a denial. Long-term rates, 10-year rates are pretty much at their cycle lows, even though we are nowhere near the double-digit unemployment rates that at one point told you that the Fed was a long, long way from raising short-term rates. It really doesn't make sense for people to be buying 10-year U.S. Treasuries near 2% if a few years from now you're going to be able to get 2% on an overnight rate of interest. What's been driving that is flows out of other countries where rates are even lower, but the dollar is moving stronger and stronger, and at some point the dollar looks strong enough against the euro that taking money out of Europe and putting it into the U.S. brings an additional risk of that one day the dollar could give up some of these gains. So our view is that tenure rates in the U.S. at some point in 2015 could flirt with levels pretty close to 3%. I know that sounds shocking from where we are now, but we were at 3% when the Fed first whispered that they were going to start unwinding the tapering, the QE spending, and we were years still away from rate hikes at that point. So that's still, however, a relatively low rate of interest by historic standards, by the standards of anything other than the last couple of years. Here in Canada, because the Bank of Canada is not in as much of a hurry to hike, I think the worst we'll see is 2.5% tenure rates, maybe even a shade under that. But again, that's still higher than we are now. So government bonds, usually thought of as the safe asset, may not be the safe asset for 2015. I think being in the corporate bond world gives you a little bit of a better running yield and offers better value as a result. In terms of currencies, this is an era where the dollar is supreme. I expect that to run a little while longer, helped by the fact that the U.S. is going to be raising rates years before many other central banks do so. But we've already done a lot of the work there. Europe is starting to look quite competitive at current exchange rates. I think we'll start to see that in some improvement in Europe's export performance. Same is true for Japan. So while there's room to run there for the dollar, it's not an endless process that takes right through the year. In terms of the Canadian dollar, I think we will see numbers like 80 or 81 cents on the Canadian dollar in the wake of the Fed hiking and the Bank of Canada delaying. But from my view, that's a good thing for the Canadian economy. It's going to help us transition growth away from debt finance consumption towards a little bit more on the export front. So that's currencies, that's fixed income. Now let me talk about the tougher world. What about commodities? What about equities? In the case of commodities, I joked the other day that the title of the movie for commodities in the coming year, Dawn of the Dead. Now, dead implies where we're starting from, which is that global growth does not look promising enough, and that's why we're seeing the weakness not just in oil, but remember, in other cyclical materials like copper, even natural gas has come down a bit, all due to doubts about the pace of global growth. But by the time we end the year, remember that what will count is perceptions on what 2016 is going to look like. And after a dose of stimulus on the monetary policy front in Europe, a dose of fiscal stimulus in China, another year of low interest rates generally from central banks around the world, my view is that the global outlook will look better for 2016, and that we will see, therefore, at some point in the latter part of the year, the dawn of the dead, that is, the beginnings of a turn towards a brighter outlook for commodities. And where does that then leave the Toronto equity market, where some of us certainly have our money and others of us earn some of our fortunes in terms of trying to make that market work for raising funds and for investors? Well, at the start of the year, it certainly looks like the S&P has it over the Toronto equity market. They're lighter weighting in cyclicals. Their banking sector looking at an environment where they've got more room, at least more years ahead, to start growing things like mortgage lending and consumer lending. That certainly is an attraction, and I would agree that they would be doing better on the banking front if they weren't pummeling themselves with fines, but at some point that will ease up. So the S&P is starting the year, I think, in somewhat better shape than the Canadian equity market. And within the Canadian equity market, I think what we're going to see is still an appeal towards the kind of assets that are either not so cyclical, that are basically dividend-type vehicles that substitute for very low bond yields, or equities that are levered to that improvement that we're seeing on the U.S. side. But this is likely to be a tale of two halves, and I don't know whether it will divide up exactly in the middle of the year, or whether the turn will be even in the third or beginning of fourth quarter. But at some point, the equity market, which is forward-looking, will look ahead to that better times for the global economy in 2016. And I think at that point, the brave investors will be adding assets in sectors like energy, counting on that comeback. And the TSX could well do what it did in the first half of 2014 before the jitters grew on global growth, which is start to outperform again the S&P 500. So the end of the year may well be the time for the TSX to shine. The first half of the year may be more a time for the S&P to shine. But nevertheless, I think in the case of both markets, while we're only looking for possibly high single-digit returns, so not a spectacular year, it's still an environment in which equities should be moving higher over the course of the year. Earnings growth from TSX companies may be in mid-single digits, so it's not a banner year for earnings, although those earnings will be helped in the case of exporters by translating foreign revenues into a cheaper Canadian dollar. But the bond yields are so low that actually, even with that tepid growth, stocks look, in my view, still pretty cheap. The gap between the earnings yield on equities and the yield you get on a 10-year bond is actually much wider than it is normally. So right now, the equities have an edge over bonds that's wider than normal, and that would still be true if 10-year Canadian bonds were trading at 2.5%. And when we end the year, if we're talking about where the valuations will be at the end of 2015, given that we expect double-digit earnings to return in 2016, there's room for the equity market late in the year to capture that better performance. So, if there's a book title for equities, it's something like "I'm okay, you're okay." Both the U.S. and Canadian equity markets look okay, even if they don't necessarily look spectacular. And I always say that when you come to an event like this and you get to chat around the kind of people we have at the head table, as I had the opportunity to, you always come away learning something. And I did learn something that made me very optimistic, and I want to close with that. What I learned is that there is still, at my age and my height, I'll stretch it, say I'm 5'9", a Hall of Fame that I can aspire to be a member of. And I hadn't known that in the past, so the Hockey Hall of Fame is probably not an odds-on bet, but for me, I'm hoping that one day, if some of this optimism that I expressed to you today turns out right, that I too could be in the investment industry Hall of Fame. Thanks very much.
You made the complicated simple. Thank you. I'd like now to invite William White, who is an Empire Club director, to join me at the podium to thank our guests. And there you are. I just want to mention as he joins me that this is our 21st financial outlook. And Bill has been involved in, I think, each and every one of them. So I just wanted to take a moment to acknowledge that and to thank Bill on behalf of the club.
Thank you. Madam President, distinguished head table guests, fellow members and guests of the Empire Club of Canada, I have the pleasure now to express our formal thanks to our three key speakers and their firms. Tom Caldwell, Chairman and CEO of Caldwell Securities, Ian Russell, President and Chief Executive Officer of the Investment Industry Association of Canada, and Avery Shenfeld, Managing Director and Chief Economist of CIBC World Markets. Gentlemen, what you did today, why you did it, and how you did it helps each one of us to better understand and embrace the capital markets for this new year. Each of your presentations pointed out how attractive this recent cycle has been, as well as the challenges and the opportunities available in 2015 to all of us as Canadian investors. Ladies and gentlemen, please join me now in a very warm and special thank you to Tom Caldwell, Ian Russell, and Avery Shenfeld.
I'd like to thank, in addition, IBK Capital Corporation, CIBC Wood Gundy, TMX Group, Desjardins, Prospectors and Developers Association of Canada, the Canadian Securities Exchange, Weir Folds LLP, BMO Financial Group, Wildeboer Delis, TD Newcrest, Hart Gold Corp, Gluston Chef, GMP Securities, Agnico Eagle Mines Limited, Scotia McLeod, and Bullion Management Group, Inc. for being our gold sponsors today. Thank you all. I would also like to thank Caldwell Securities and CIBC for being our event sponsor. Let's take a moment. Thank you to IBK Capital Corp and BMO Nesbitt Burns for sponsoring our student tables today. Lastly, I would like to thank the Investment Industry Association of Canada for being our presenting sponsor today. Thanks to the National Post, which is our print media sponsor. You can follow us on Twitter at empire_club and visit us online at www.empireclub.org. Thank you all for coming. We hope to see you again soon at one of the very exciting upcoming events that you'll see advertised in the red brochures that are on your tables. Thank you for coming. This meeting is now adjourned.